Right now, the headlines want you to believe that metals are losing their shine, prices are off their highs, charts look tired, commentators are suddenly quiet, and just like that, the crowd assumes the story is over. But if you've been paying attention, really paying attention, you know this is not the end of the story. This is the setup. What we are witnessing ahead of the 2026 index rebalancing is not a collapse in value. It is a shift in positioning. Index rebalancing is a mechanical process. It doesn't ask whether silver is essential to solar panels, whether copper is the backbone of electrification, or whether gold has preserved purchasing power for thousands of years. It simply reallocates capital based on formulas, weightings, and mandates. And when trillions of dollars move mechanically, prices can be pushed temporarily away from reality. Index rebalancing is often dismissed as background noise, something technical, something only portfolio managers need to worry about. But that assumption is precisely why it becomes so powerful. When large institutions rebalance indexes ahead of 2026, they are not making value judgments. They are not asking whether silver inventories are shrinking, whether copper demand is accelerating, or whether gold remains the ultimate monetary reserve. They are executing mandates, and mandates move capital without emotion, without context, and without regard for consequences. This matters because trillions of dollars are tied to these indexes. Pension funds, sovereign funds, ETFs, and large asset managers must buy and sell according to preset rules. When those rules change, capital flows change and prices respond, sometimes violently. This is not a reflection of economic health or metal scarcity. It is a liquidity event, and liquidity events create distortions. During rebalancing, assets that have outperformed are often trimmed, while others are reduced simply because their weighting no longer fits the formula. Metals frequently fall into this category, not because their role has diminished, but because paper positioning has become crowded or inconvenient. The selling pressure that follows is mechanical. It has nothing to do with long-term value and everything to do with short-term compliance. This is where the danger lies for the uninformed. When prices fall, the narrative follows. Suddenly, metals are weak. Suddenly, demand is questioned. Suddenly, people forget why these assets mattered in the first place. But beneath the surface, something very different is happening. Physical markets do not rebalance. Mines do not produce more because an index says so. Refineries do not speed up because a fund manager hit a sell button. Liquidity events expose the difference between paper and reality. Paper prices can be pushed down quickly. Physical supply cannot be created quickly. That gap is where opportunity lives. Every major transfer of wealth in history has been preceded by confusion. Those who understand structure recognize rebalancing for what it is, forced behavior. Those who don't interpret it as a signal of failure. This is why weak hands exit near lows, while strong hands accumulate quietly, patiently, and deliberately. It's also important to understand timing. Rebalancing pressure is temporary, but the consequences of positioning are long-lasting. When selling is exhausted, it stops abruptly, and when it stops, prices don't totally drift higher. They reset often faster than people expect and far earlier than the headlines acknowledge. Liquidity events don't destroy value. They reveal it. They test conviction. They punish those who chase momentum and reward those who understand cycles. If you've lived through enough of these periods, you begin to recognize the pattern. First the pressure, then the silence, then the realization that nothing fundamental actually changed. Index rebalancing ahead of 2026 is not a warning sign. It is a stress test. And stress tests don't exist to comfort you. They exist to show you where the system bends and where it breaks. When people look at falling prices, they assume something is wrong with the asset. But in the metals market, that assumption is often backward. Price is not truth. Price is a reflection of leveraged paper contracts and short-term behavior. Value, on the other hand, lives in the physical world, and this is where the disconnect becomes impossible to ignore. Paper markets can create the illusion of abundance. Contracts can be written in unlimited quantities, traded at lightning speed, and settled without ever touching a single ounce of metal. That system works until it doesn't. When index rebalancing and institutional flows push prices lower, paper markets respond instantly. Algorithms sell, funds comply, charts break, but physical supply does not suddenly increase. In many cases, it tightens. Silver illustrates this perfectly. On paper, it trades like a speculative asset. In reality, it is being consumed. Unlike gold, most silver is not sitting in vaults waiting to be resold. It is dispersed and often unrecoverable. Electronics, solar panels, medical applications, these uses don't pause because futures prices dip. Demand continues while inventories quietly decline. That divergence cannot persist indefinitely. Gold tells a different but equally revealing story. Gold's role is not consumption, it is preservation. While price fluctuates, gold steadily migrates from weak balance sheets to strong ones. From sellers who need liquidity, buyers who understand monetary history. This transfer does not show up in daily price charts, but it shows up in vault movements and long-term ownership patterns. Gold does not disappear, it changes hands. Palladium and copper sit at another critical intersection. They are industrially essential, geopolitically sensitive, and constrained by real-world production limits. Mining is capital-intensive, slow, and increasingly regulated. Supply cannot respond quickly to price signals. Yet paper markets treat these metals as if supply is flexible and infinite. It is not. This is the core misunderstanding. Paper markets set price, but physical markets set the limit. You can push price below value for a time, but eventually the physical market pushes back. When it does so abruptly. Premiums rise, availability tightens, delivery delays appear, and suddenly the paper price no longer tells the full story. History shows that the most dangerous moment is not when prices are high and excitement is loud. It's when prices are low and confidence is gone. That is when the largest transfers of physical metal occur, not because market agrees, but because most people are discouraged. Index rebalancing accelerates this process. It adds artificial pressure to an already distorted system, and in doing so, it widens the gap between price and reality. Those who only watch charts see weakness. Those who watch supply see stress. The question is never whether paper markets can push prices around. They can. The real question is how long physical markets will tolerate it. And the answer, time and again, has been the same. Not forever. Silver and copper occupy a unique and increasingly uncomfortable position in the global system. They are treated like commodities, traded like speculation, and priced as if they were optional. But in reality, they are foundational. They are not luxuries. They are requirements, and that distinction is becoming more important as the world attempts to transition into something it has never fully built before. Silver is often misunderstood because it wears two masks. On one side, it is money. It has been recognized as a store of value for thousands of years, long before modern financial systems existed. On the other side, it is an industrial workhorse. It conducts electricity better than any other metal. That fact alone makes it indispensable. Solar panels, electronics, medical equipment, defense technologies, these systems do not function without silver, yet most silver mined is consumed, not stored. Once used, much of it is gone. Copper is even more revealing. Copper is the metal of connectivity. Every electrification plan, every renewable energy target, every expansion of digital infrastructure depends on copper. Electric vehicles require several times more copper than traditional vehicles. Power grids must be expanded and reinforced. Data centers consume enormous amounts of wiring and cooling systems. Copper demand is not theoretical, it is structural. Now look at supply. New mines take years, often decades, to develop. Environmental restrictions, political instability, and declining ore grades make expansion slower and more expensive. You cannot flip a switch and produce more copper or silver because prices moved last quarter. Supply responds slowly while demand accelerates. This is where the tension builds. Paper markets can suppress prices temporarily, especially during index rebalancing and capital rotations. But they cannot eliminate need. They cannot change physics. Electricity still requires conductivity. Infrastructure still till metal. Technology still requires materials that actually exist in the physical world. When prices fall, the signal sent to producers is to invest less, exploration budgets shrink, development is delayed. That sets the stage for future shortages. The irony is that low prices today often guarantee higher prices tomorrow, not because of speculation, but because of neglect. Silver and copper also expose a deeper issue: the fragility of systems built on assumptions rather than resources. You can announce goals, pass legislation, and issue bonds, but you cannot build without materials. When demand meets constrained supply, something must give. Historically, that something is price. The public tends to notice this too late. First, prices drift lower and sentiment fades. Then inventories tighten quietly. Then availability becomes an issue. And finally, prices respond sharply as the market scrambles to reconcile paper promises with physical reality. This is not a sudden event. It is a process. And processes favor those who prepare early, not those who react late. Silver and copper are not simply investments. They are signals. They tell you whether the system is aligned with reality or drifting further from it. When they are undervalued and underappreciated, it is often because the gap between financial narratives and physical truth has widened dangerously. And when that gap eventually closes, it does so without apology. Gold and palladium reveal something that most people would rather ignore. True scarcity does not announce itself politely. It waits. It allows complacency to build. And then, when conditions are right, it reasserts itself with force. These two metals are not interchangeable, but they share a critical trait. They are constrained by reality, not promises. Gold has survived every monetary experiment because it exists outside the system. It is no one's liability. It does not depend on confidence in a counterparty. When prices soften due to institutional selling or index rebalancing, it is not because gold has failed. It is because paper claims on gold are being adjusted. Physical gold does not rebalance. It does not get diluted. It does not default. Throughout history, whenever currencies are expanded beyond discipline, gold quietly absorbs excess confidence. Central authorities understand this better than the public. That is why gold continues to move into long-term holdings, even during periods of price increases. These movements are not emotional, they are strategic. They reflect an understanding that monetary systems change, but gold's role does not. Palladium is different in function, but similar in lesson. Its supply is geographically concentrated and politically sensitive. Production disruptions are not hypothetical, they are recurring. Palladium cannot be easily substituted in many of its already applications. When demand rises or supply falters, there is very little buffer. Inventories are thin, response time is slow, yet palladium trades in markets that assume flexibility. Futures markets price it as though supply can expand smoothly and demand can be deferred indefinitely. Neither assumption is accurate. When selling pressure emerges, often driven by capital flows rather than fundamentals, prices retreat, but the underlying vulnerability remains. This is the illusion created by paper markets. They suggest control where none exists. They imply abundance where scarcity is growing. They create comfort right before discomfort becomes unavoidable. Gold and palladium serve as reminders that not all assets are equal. Some assets represent claims, others represent ownership. Claims can be multiplied, ownership cannot. When stress enters the system, this distinction becomes everything. Thomas telling moments are not when metals surge, but when they are ignored. When prices drift lower, when narratives turn dismissive, and when attention shifts elsewhere. That is often when accumulation occurs by those who understand cycles. These participants are not reacting to headlines. They are responding to structure. Scarcity is patient. It does not need constant validation. It only needs time and pressure. And the current environment is full of both expanding monetary obligations, tightening resource constraints, and mechanical selling driven rebalancing create a fragile equilibrium. Eventually, something breaks that equilibrium. Not gradually, but suddenly. Gold and palladium do not warn loudly. They simply move. And when they do, the conversation shifts from why they mattered to why they were ignored. Every major cycle ends the same way, but it never feels that way while you're inside it. Confusion replaces clarity, volatility replaces confidence, and people begin to doubt the very assets that once made the sense. This is not accidental. This is how wealth transfers occur, quietly, systematically, and always from the impatient to the prepared. Rebalancing cycles accelerate this process. They force selling where selling is not logically required. They compress prices at the exact moment fundamentals are tightening. And in doing so, they create emotional pressure. Most people don't exit because they've analyzed supply, demand, or monetary history. They exit because price moved against them and certainty disappeared. That is the trap. Markets are designed to reward discipline, not agreement. The crowd always finds reasons after the fact. First, prices fall, then narratives appear to justify the fall. Then participation thins out. This sequence has repeated across centuries, across asset classes, and across every form of money humanity has ever used. The metals market is no different. Silver, gold, palladium, and copper don't need constant enthusiasm to function. They need scarcity, utility, and time. Those conditions already exist. What's missing is patience. Volatility is not risk. Misunderstanding is risk. Volatility exposes who owns assets for reasons and who owns them for comfort. When price swings intensify, comfort disappears. That is when ownership changes hands. History does not reward those who wait for reassurance. By the time reassurance arrives, prices have already adjusted. The opportunity exists earlier, when doubt is widespread and conviction is rare. That is when assets are undervalued, not because they are unimportant, but because they are misunderstood. There is also a deeper lesson here about systems. Financial systems prefer predictability. Real-world systems do not. Mining takes time, energy requires materials. Infrastructure requires metals that cannot be printed, duplicated, or raised up by policy. When financial expectations collide with physical limits, one side must yield. It is never the physical side. This is why metals matter during periods of transition. They are not dependent on promises. They are not reliant on solvency. They exist regardless of policy direction or political outcome. They simply are. Rebalancing ahead of 2026 is a moment of stress, not a moment of failure. Stress reveals structure. It shows where leverage exists, where confidence is thin, and where reality is being postponed. Those signals are invaluable, but only if you're willing to read them. At the end of every cycle, people ask the same question: how did this happen so quickly? The answer is always the same. It didn't. It happened slowly, then all at once. The real decision is never about timing the exact bottom. It's about understanding whether value is being eroded or merely obscured. When value is obscured, patience becomes power, and power in every financial era belongs to those who understand that real wealth is built when the crowd is looking the other way. So as we move closer to 2026, don't ask why metals are weak. Ask who is selling and why. Ask whether the physical world is changing in the same direction as the paper Paris. Because when those two diverge long enough, the resolution is never subtle. The greatest mistake investors make is waiting for clarity. Clarity always comes after the move, never before. By the time metals are back in favor, they will no longer be cheap, ignored, or easy to accumulate. This is not the moment for fear. This is the moment for understanding, for patience, for recognizing that real wealth is built when value is quiet and conviction is rare. Because when the rebalancing is complete, when the formulas finish their work, and when reality catches up to price, the question won't be whether metals mattered. The question will be whether you were positioned before everyone else remembered why they always have.